everyone, and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Yeah, it's great to be here. I've got some really exciting stuff lined up, especially if you're looking to enhance your real estate investing skills.
Absolutely. Today we're diving into something super practical. How to master tools like Rentometer and RentRange. These are key for understanding rental markets, and they can really make a difference in your investment strategy.
Right, and for those over 40, it's all about building that long-term wealth, We'll touch on how these tools can help you analyze rental properties more effectively.
And we'll also chat about common pitfalls to avoid, plus some tips on how to streamline your research process. I think a lot of listeners will find that really valuable.
For sure. It's all about making informed decisions. And having the right information at your fingertips can really empower you.
So, whether you're just starting out or looking to refine your approach, there's something here for everyone. Let's get into it.
Yeah, let's jump right in. First off, what exactly are Rentometer and RentRange, and how do they fit into your real estate toolkit? So, Sarah, when we talk about tools like Rentometer and RentRange, it really hits home for folks over 40. Especially given the economic climate we're navigating today.
Absolutely, Mike. With inflation creeping up and market shifts happening more frequently, understanding rental trends becomes crucial, right? It's not just about making a quick buck. It's about securing long-term financial stability.
Exactly. For a lot of listeners, they might be thinking about retirement timelines. If you're in your 40s or 50s, you're really starting to plan for that next chapter. Having reliable rental income can be a game changer.
Right, and I've spoken to several investors who, after realizing how volatile the stock market can be, turned their focus to real estate. It's like a safety net for them. They want something tangible, something they can control.
Yes, and let's not forget about the emotional side of financial security. It's one thing to have a number in your bank account, but it's another to know that you have properties generating income. It gives you peace of mind, especially as you think about transferring wealth to your family.
That really resonates. I remember chatting with a listener. Let's call her Lisa. She was in her late 40s and had been investing in real estate for a couple of years. She mentioned how her rental properties not only provided her with extra income, but also allowed her to plan trips with her family without stressing about finances.
That's a great example. It's about creating experiences and memories, not just accumulating wealth. And when Lisa shared that, it made me realize how important it is to have that flexibility in life.
Exactly. And with the way the economy is shifting, people are looking for stability. They want to know that their investments can weather the storm, so to speak. Having reliable rental income can buffer against inflation, too.
That's a key point. If you think about it, rental prices often rise with inflation, which means your income from properties can keep pace with or even outstrip inflation. It's a hedge against the cost of living increasing.
That's something a lot of people may overlook. They see property as a long-term investment, but they often don't think about how it can actively protect their financial health in the short term as well.
Right. And let's not forget the current trends in housing. With so many people looking to rent instead of buy, especially younger generations, the demand for rental properties is likely to stay strong. This can create a great opportunity for investors.
Yes, and I think about the changing demographics, too. More people are delaying homeownership, whether due to economic factors or lifestyle choices. This shift means that investing in rentals could be a solid strategy moving forward.
Absolutely. And speaking of demographics, I once spoke with a gentleman we can call Tom. He was in his early 50s and had inherited a couple of properties. Instead of selling them for a quick profit, he decided to rent them out. He told me he felt a sense of purpose in being a landlord, providing homes for families.
That's a beautiful perspective. It shows how real estate can be more than just an investment. It's about contributing to the community, and that can be incredibly fulfilling, especially as you think about your legacy.
Yes, and we've got to acknowledge the wealth transfer aspect too. As boomers pass down assets to their children, it's crucial for the next generation to understand how to manage and grow that wealth. Properties can play a vital role in that conversation.
Definitely. It's like setting up your kids for success. They might not be interested in managing a stock portfolio, but real estate could be something they can grasp and appreciate more easily.
And when we think about the practical side of things, Tools like Rentometer and RentRange can help both seasoned investors and newcomers understand what their properties can bring in. They provide the data to make informed decisions.
Exactly. It's not just guesswork anymore. You can analyze trends, see what's happening in your local market, and adjust your strategies accordingly. That knowledge is power, especially when you're planning for retirement.
Right. And it's also about having a proactive approach. Instead of waiting for the market to dictate your moves, you can be ahead of the curve, ensuring your investments remain strong.
And that proactive mindset can really shift the way someone feels about their financial future. Instead of worrying, they can feel empowered knowing they have a strategy in place.
Well said. And it's about more than just the numbers, too. It's about creating a life that aligns with your values and priorities. Real estate can provide that freedom to step back and enjoy life a bit more.
Exactly. So as we dive deeper into strategies for using tools like Rentometer and RentRange, I think it's essential for our listeners to remember that these are just tools to help them build that foundation for a secure future.
Yes, and the key is using that data to make informed, confident decisions. It's all part of the journey toward financial independence and peace of mind.
Let's explore some core strategies that can really maximize the benefits of these tools.
So Sarah, let's dive into some core strategies that can really help our listeners when it comes to tools like Rentometer and RentRange. I think starting with the basics, like the 1% rule, is a good idea.
Absolutely. The 1% rule is a simple way to evaluate whether a rental property could be a good investment. It basically suggests that you should aim to rent the property for at least 1% of the purchase price every month, right?
Exactly. So if you're buying a property for, say, $200,000, you'd want to see monthly rents around $2,000. It's a quick check to assess cash flow potential, but of course it's not the only factor.
Right, and that leads to the 50% rule, which is another useful guideline, especially for estimating expenses. It's a quick way to assess how much of your rental income will be eaten up by costs, like maintenance and property management.
Yeah, the 50% rule suggests that about 50% of your rental income will go toward operating expenses. So if you're bringing in $2,000 a month, you might estimate about $1,000 for expenses. That gives you a clearer picture of your net income.
Exactly, and then you can calculate cash flow from there. If you have $2,000 in rent, subtract the $1,000 expenses, and let's say you have a mortgage payment of $800. That leaves you with $200 in cash flow each month.
Right, and that's a good start. But it's also important to think about the cap rate, or capitalization rate, which helps evaluate the property's potential return on investment.
Oh, for sure. The cap rate is calculated by taking the net operating income, which is your income minus expenses, and dividing it by the property's purchase price. So continuing with our example, if your net income is $1,200 a month, that's $14,400 a year. That's
right. And if the property is still $200,000, you'd calculate the cap rate like this: $14,400 divided by $200,000, which gives you a cap rate of 7.2%. A higher cap rate typically indicates a better investment.
And that can vary by market, right? Some markets might see lower cap rates, but they also might have more stability or appreciation potential.
Exactly. It's all about balancing risk and reward. Now, let's talk about how to use Rentometer and RentRange effectively. Both tools can help you analyze the rental markets in your target areas.
Right. Rentometer gives you a quick snapshot of what similar properties are renting for in the neighborhood. You just plug in the address and get a sense of the average rent, plus how your property compares.
Yes, and it's important to consider the quality of the property too. You might find that a property is renting for $1,800, but if it's in need of a lot of repairs compared to yours, that needs to be factored in.
Absolutely. And RentRange goes a step further by providing data on rental trends, demographics, and even potential appreciation rates. It's great for understanding the broader market context.
Right, and when using these tools, it's helpful to look at a range of properties, not just one or two. The more data you have, the clearer your picture becomes.
Yep, and then you can create a deal evaluation checklist. I think it's critical to have a checklist to ensure you're not missing anything.
Totally. So let's think about what might go on that checklist. You'd want to start with the purchase price and the estimated rental income, right?
For sure. Then include your estimated expenses, which we talked about earlier, like property taxes, insurance, maintenance costs, and management fees.
Yep, then you'd also want to calculate your potential cash flow and cap rate as we've discussed. And don't forget to factor in financing options, whether you're going conventional, FHA, or even using a portfolio loan.
Great point. Financing can significantly affect your cash flow. For instance, a lower interest rate can improve your monthly cash position, while a higher rate could squeeze your margins.
Exactly, and it's also wise to consider the type of property you're looking at. Single-family homes typically have different dynamics compared to multifamily units and even commercial properties.
Right, single-family homes might be easier to finance, but multifamily units can provide more rental income and diversification.
And speaking of diversification, it's always beneficial to look at different markets. Sometimes investing in a growing area can yield better returns compared to established markets that are already saturated.
Yeah, and that's where tools like Rentometer and RentRange come in handy again. They help you spot emerging neighborhoods with potential.
Right, you want to be ahead of the curve. And remember, investing in real estate is a long game. It's not just about the initial cash flow, but also about the long-term appreciation of the property.
Exactly. And that appreciation can really add up over time. But let's not forget, there are common pitfalls to watch out for.
Oh, definitely. It's easy to get caught up in the numbers and forget about the local market conditions.
And that can lead to making decisions based on outdated data, right?
Yes, and not doing thorough due diligence can be a costly mistake. Always ensure you have the complete picture before jumping into a deal.
So, keeping those strategies and rules of thumb in mind can really help mitigate some of those risks.
Exactly. Now let's shift to those common pitfalls. So Sarah, when we talk about common pitfalls in real estate investing, one of the biggest, I think, is over-leveraging.
Absolutely, Mike. It's such a tempting trap, isn't it? Investors get excited and think, the more I borrow, the more I can buy. But sometimes that can lead to serious trouble.
Right, and it can happen really quickly. I remember a client of mine, let's call him Tom. He bought 3 properties in a single year, all with high leverage. At first, it seemed great. Cash flow was positive. He was feeling like a rock star. But then, the market shifted slightly.
Oh no, what happened?
Well, he started to struggle with cash flow when a couple of his tenants moved out at the same time. Suddenly, he couldn't cover the mortgage payments, and the stress just piled on.
That's tough. It's like a domino effect, isn't it? One thing goes wrong, and everything else starts to tumble.
Exactly. And that's why I always stress the importance of having a buffer, extra savings to cover unexpected expenses. You really want to avoid being in a position where you're relying solely on rental income to meet your mortgage.
You said it. And speaking of tenants, that's another big pitfall. Bad tenants.
For sure. I've seen it happen so many times. Just the other day, I was chatting with a friend who had a nightmare tenant situation. The tenant was late on rent multiple times and eventually stopped paying altogether.
That sounds like a headache.
It really was. He was stuck with legal fees, and the eviction process took a while. And, that's not just financial stress. It's emotional, too.
Definitely. So, how can investors spot red flags before signing a lease?
Great question. I always suggest doing thorough background checks, credit reports, rental history, even talking to previous landlords. Look for patterns, If someone has a history of late payments or evictions, that's a red flag.
That makes total sense. And sometimes it's about trusting your gut as well. If something feels off during the interview, it probably is.
Exactly. And then there's the issue of ignoring cash flow. It's easy to get caught up in the excitement of buying a property, but if you're not paying attention to whether the rent covers your expenses,
you could be setting yourself up for failure, right?
Absolutely. I had a client, let's call her Lisa, who bought a property thinking it was a steal. She focused on the potential appreciation, but didn't calculate the monthly expenses properly. After a few months, she realized her cash flow was negative, and she had to dip into her savings.
Yikes! That's a tough lesson.
It is, and it's also about understanding your market. If you're in a market that's cooling down, it's crucial to be aware of timing. Some investors think they can time the market perfectly, but that's notoriously tricky.
Right. Timing the market is like trying to catch a falling knife. It can be risky.
Exactly. I've seen investors who held off buying, waiting for the perfect moment, only to watch prices keep climbing. You can't let that fear of missing out paralyze you.
So it's about finding a balance, right?
Yes, invest when the numbers make sense for you, not just because you think the market is about to boom.
And speaking of numbers, hidden costs can really catch people off guard.
Oh, definitely. I remember a case where an investor purchased a property but didn't account for maintenance costs or property taxes. They were shocked when those expenses hit.
Yeah, those extra costs can really add up.
They can, and that's why I recommend building a detailed budget for every property. Factor in everything: repairs, management fees, even potential vacancy periods.
That's smart advice, Mike. So if someone finds themselves in a tough spot due to any of these pitfalls, what's the best way to recover?
First, take a breath. It's easy to feel overwhelmed, but there are steps you can take. If you're over-leveraged, consider refinancing to lower your payments, or even selling a property if necessary.
That's a good point. And for bad tenants, it's important to follow the process legally.
Exactly. Document everything, and don't skip the necessary steps. And if cash flow is an issue, reevaluate your expenses. See where you can cut back.
Right. And maybe even look at increasing rents, if possible, or finding ways to attract better tenants.
Yes, and for hidden costs, always do your homework. Get a thorough inspection before you buy, and be conservative in your estimates.
It sounds like a lot of it comes down to proper planning and being proactive instead of reactive.
Absolutely. The more informed you are before making decisions, the better off you'll be.
And remember, it's a learning process. Mistakes can happen, but they don't have to be the end of your investing journey.
Exactly. Just take them as lessons and adjust your strategy moving forward.
So for our listeners, the key takeaway here is to stay vigilant, do your due diligence, and keep your finances in check.
Well said, Sarah, and remember, it's all part of the journey toward building that long-term wealth in real estate.
Absolutely. And with that, let's talk about what steps our listeners can take next.
All right, so let's dive into some immediate steps listeners can take right now to really leverage tools like Rentometer and RentRange.
Yeah, absolutely. I think the first thing to do is to get familiar with these platforms. Rentometer, for example, is super user-friendly. You just enter the address of a property, and it gives you a comparative rental analysis.
Exactly, and it can really help you understand what the market's doing. I suggest checking it regularly to track any changes in rental prices in your area. It's a great way to start thinking about potential returns.
Right. And for those who want to dig a little deeper, RentRange offers more detailed insights, like demographic data and trends over time. It's like having a mini market research team at your fingertips.
That's a perfect way to put it. And if you combine these tools with, say, local MLS access, you can really refine your investment strategy. You can see not just rental prices, but also sales trends.
Oh, definitely. And let's not forget apps like Zillow and the Bigger Pockets calculator. They're fantastic for quickly assessing property values and potential cash flow, right?
Yes, and for those who might be new to this, I'd recommend starting small. Maybe pick one deal a week to analyze using these tools. Just, get into the habit of looking at the numbers.
That's a great idea. And speaking of habits, joining a local real estate meetup can be a game changer. It's a chance to network, learn from others, and share experiences.
Oh, for sure. Surrounding yourself with like-minded individuals really boosts your confidence and motivation. Plus, you might find a mentor or partner to collaborate with.
Yes, and there are also tons of great books and podcasts out there. I mean, have you checked out the book on rental property investing by Brandon Turner? It's really insightful.
Absolutely. And for podcasts, Bigger Pockets Podcast is a classic. They cover so many real-world scenarios and interviews with successful investors, which can be inspiring.
Right? And starting with just one or two actionable insights from those resources can really, propel you forward.
Definitely. And don't feel overwhelmed. Just start where you are, Maybe set a goal to analyze that one deal a week, or even just spend an hour a week on those platforms.
That's so true. Even small steps can lead to big changes over time. It's about building that momentum, right?
Exactly. And as you get comfortable, you can start branching out into more complex deals. But the key is to, build that foundation first.
Yeah, and it's also about staying consistent. Maybe set reminders in your calendar to check in on those properties or listen to a podcast episode.
Great tip. Regular check-ins keep you engaged and help you stay updated on the market. Maybe even set a weekly review of your findings, too.
I love that. And for our listeners, don't forget to document your journey. Keeping a real estate journal can help you track your progress and reflect on what you've learned.
That's a fantastic idea. Plus, it can help clarify your thoughts and strategies as you move forward. It's all about, creating your own path in this journey.
Exactly. And remember, it's okay to ask questions. Online forums, social media groups, they can be great places to find support and advice.
Yes, and that's a crucial part of learning, engaging with the community. So if you're feeling stuck or unsure, reach out.
Absolutely. So with these tools and habits in your toolbox, you're really equipped to take action.
Definitely. And as you start using them, you'll find your confidence will grow. And so will your understanding of the market.
Yeah, and it's really about, enjoying the process. Each step, no matter how small, is a step toward your financial goals.
So those are some practical first steps. Now let's bring this all together. All right, so let's wrap up what we've talked about today.
Absolutely. So first off, using tools like Rentometer and RentRange can really help you get a clear picture of rental markets, right?
Yeah, for sure. Understanding those local market trends is crucial. It's like having a roadmap for your investment journey.
And then we touched on the importance of analyzing comparable properties. That's where you really see what the competition looks like, and it helps you set those realistic expectations.
Right, and don't forget the power of data. Using these tools gives you insights that can help you avoid costly mistakes. It's really about making informed decisions.
Exactly. And the last key takeaway, I think, is the emphasis on continuous learning. The more you know, the better equipped you are to navigate the real estate landscape.
Well said, Sarah. Building wealth through real estate is a marathon, not a sprint. It takes time, patience, and a willingness to adapt.
Yes, and remember, it's never too late to start. Whether you're 40 or beyond, every step you take gets you closer to your goals.
If you found today's episode helpful, please like, subscribe, and comment below to share your biggest takeaway or any questions you might have.
And don't forget to share this with someone over 40 who's looking to invest in property. You might just inspire them to take that first step.
Next time, we're diving into Deal Check and Bigger Pockets Calculator. That'll be a great way to keep building your toolkit.
Definitely looking forward to that. Thanks for joining us today.
Yeah, thanks for listening. We appreciate you being here.
Until next time, take care.